Earlier in the summer this year, there was the widely held belief that the UK markets were underperforming on an undervaluation basis against other Western markets. Is that still the case? We're talking now to the head of equities at Schroders and co-manager on the British Opportunities Trust, which has just produced earnings. That's Rory Bateman. Rory, good to talk to you. Thanks indeed for joining us today. I want to talk first of all, though, before we get on to the markets generally, about the British Opportunities Trust. It's just produced earnings. I know you IPO'd around about a year or so ago, and I know you've come through with an overperformance on expectations. Give us some more detail about what's been happening with this trust.
Yeah, well, good morning. We're very pleased with the performance of the trust over the last, actually 10 months we've been launched now, since the 1st of December last year. It's a public-private proposition whereby we're looking to invest in great British growth companies, both on the public side and on the private side. And I'm pleased to say that we've achieved a north of 10% increase in the NAV over that period, despite obviously not being fully invested because of obviously it takes time to get involved in some of the private businesses. So really great start, and we're very pleased with progress. Lots more to go for.
What's the strategy of the trust?
We are out and out growth. On the public side, we're buying high quality growth businesses within a market cap range of 50 million to 2 billion. We've currently got 29 positions in the portfolio. And similarly on the private side, these are growth and buyout companies on the private side. We've currently got 6 in the portfolio. We're looking to increase that to 12 to 15 over the coming 6 to 12 months as we get more and more ideas coming through from the private side of the business.
I know that you are on the public side specifically. What sort of stocks are you buying? You talk about growth businesses. What opportunities do you see in the market, and what have been the best returns you've seen in the portfolio this year?
We've seen a number of good returns, and I appreciate the market has done relatively well over the last few months. We have been making really stellar returns in companies like Volution, Genuit. We've been participating in IPOs such as TinyBuild and Trustpilot. And in essence, one of the key themes of the portfolio is to provide fresh equity to UK businesses. We honestly believe that the UK is full of some of the highest quality, best managed businesses in the world. And what we want to do is provide incremental capital, because we feel, as we'll come on to later, that the UK market is still fundamentally undervalued. So by providing fresh capital, the market is beginning to price in the return profile of that incremental capital very quickly into share prices.
Well, let's pick up on that point. I think this has perhaps been most widely demonstrated by the recent bidding battle for Morrison's, which has seen us go to levels, incredible levels, compared to the sort of levels the stock was trading at before the bidding started. That, I guess, is an extreme case of potential undervaluation. But is that the sort of theme you're working to?
Well, look, we're not buying companies because of the takeout opportunity. We're buying companies because we think they're fundamentally undervalued in the UK. And as I say, and the UK contains some of the best growth businesses in the world. We do, however, recognise that the UK market is highly attractive for international private equity buyers. We've seen a record number of deals coming in this year from international private equity for UK PLC companies, and that's just indicative of the amount of value opportunities there are in the UK, and we would expect that to continue. Indeed, in the portfolio, we've already seen 2 of our public companies receive bids from private equity. So we're cognizant that it's a really attractive place for the private equity to come in and take a look.
You sound very upbeat, but I mean, there are definite headwinds, and these headwinds have developed quite quickly. I'm talking about supply chains. We've got that highlighted with the HGV driver crisis, petrol shortages. We've got a rise in the price of natural gas. We've got inflationary expectations, expected to see the Bank of England having to move up in interest rates, possibly in 2022. By what sort of margin, we don't yet know, but there's a certain expectation that inflation is going to persist. These are all headwinds, aren't they? Or do you see an opportunity here to buy into that very headwind as an opportunity in the equity markets?
Yeah, I mean, look, there's a lot of questions in there. I mean, I think from my perspective, the UK market, as I keep saying, contains some of the best growth businesses in the world. And if you are buying companies that are going through the digitalization process, so a major theme in the portfolio is digitalization. So pre-COVID, these companies were going, lots of their customer base were moving online. The business models that they were being beneficiaries of was that general move into e-commerce, into online activity. And all COVID done is dramatically accelerate that process. So a lot of the positions we have are are continuing to benefit from that process. And frankly, that's a structural growth opportunity. So digitalization, yes, it's obviously going to be impacted by markets overall, but these are structural growth stories. And on your inflation point, inflation is actually quite a good thing for equities, as long as it's not too dramatic, as long as it's expected, and as long as the central banks don't take dramatic reverse action with regards to interest rates. So I'm very comfortable with some of our more, shall we say, cyclical growth businesses. Those businesses will achieve pricing power. They are structural growth stories as well. If I think about Volution or Genuit, these businesses will do well in a moderate inflation environment. It's when you get massively rising inflation that it's negative for markets.
Can you break down this into sectors for us, or is that not something you tend to do?
Well, we have been, as I say, more on the technology digitalization end of the curve, of the spectrum. We've been playing RMI growth stories, so repair and maintenance, and that's really come through. We've seen earnings being beaten very substantially over the last 12 or 18 months. And we are playing consumer growth. So things like Gym Group, things like Delata Hotels, where we've got strong asset backing. We've got the recovery in the consumer as we go through, as we come out the other side of COVID. So we have, as I keep saying, growth businesses, lots of technology, lots of consumer growth and lots of industrial growth. Some healthcare, although healthcare is looking relatively rich, you could argue it at the moment in terms of valuations. But they're more on the growth end of the spectrum, and we are avoiding things such as fossil fuels, gambling, and tobacco and things like that. This is much more of a sustainable-led business proposition.
You said earlier on that you have spent the year buying into areas of the market. Obviously, since the IPO, it's given you opportunities to get into the market in certain other places. Do you have much cash left? What's the proportion of what you hold in cash and what you hold in equities? Do you have much left to empty into the markets, or is this a sort of an ongoing process that you will continue to find new opportunities?
Yeah, I mean, we were obviously quite optimistic about the market when we launched in December. We described it as a once-in-a-generation opportunity because we felt the market, the UK market specifically, at the lower end of the spectrum was a once-in-a-generation opportunity given the valuations. So we got out of the gate very quickly. We're now about 90% invested. The split currently is 70-30. We're looking to increase that more towards 50-50. We've got a couple of positions in the public side which we're able to sell down in order to fund some of the private deals as they come through. But we're making great progress, exactly as we said at the time of the IPO. And so we will get to a 50-50 within the next 6 to 12 months. And all of the stocks that I've talked about are reminiscent of what we'll be doing going forward.
Well, let's finish off by talking about next year and how you see things developing. You've given an insight into how you want to position yourself and the British Opportunities Trust. But how do you see the markets overall developing next year? We've spoken about some of the headwinds, as you say. There's a lot of things to contend with. One of the things I didn't mention, of course, was increased taxation, which is going to be an extra burden, of course, on us, the consumer. But adding all these things together with, as you say, what you perceive to be opportunities in the market, how do you see things developing into 2022 and beyond for UK PLC and the equity markets as things stand?
Well, you know, I think notwithstanding the tax increases on the consumer, I think we do have a chancellor that gets it. I think there's a lot of activity around the UK market. They really are trying to help the UK market develop into what it should be, frankly. We are one of the pioneers of stock markets and capital raising around the world. I think we've fallen behind from a regulatory perspective. We're looking to make lots of changes, and we're very supportive of those changes in terms of the Lord Hill review and so on. With regards to what's going to go on in the market in terms of movements, if you look at the UK market, we were at the trough, we're trading around 40% discount to the likes of the European markets and the US market. We're now still trading at 30% discount. So we've closed some of that gap, but it strikes me that across all the sectors, so this is not just about banks and energy. If you look at individual sectors, the UK market continues to trade at a significant discount across all of those sectors. So what we've got to do is identify the best growth categories in each of those sectors where we're interested and try to get them into the portfolio. So I'm thinking that, yes, things are not as clear cut as they were a year ago. Things will be more difficult. Things are certainly going to be more volatile. But I'm relatively optimistic on the quality of the UK businesses that we're buying, and the UK market overall looks fine to me.
Look, okay, it's a fascinating subject. Thanks indeed for joining us, Rory. It's great to get some of your time, a busy man that I know that you are. Rory Bateman, head of equities at Schroders and co-manager on the British Opportunities Trust. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.